Sir, very happy afternoon to all. Sir, those who are in online, I believe that voice, video, everything is perfect. It's very happy afternoon to all. If anyone who are in live. Yes, sir. Sir, the first two chapters of the financial management is leverage analysis and the ratio analysis. In that, leverage analysis is sales minus variable cost contribution minus fixed cost earnings before interest and tax. From that, we have to reduce the interest, you will get the earnings before tax. Pay the tax, you will get the PAT. Pay the preference dividend, you will get the residual earnings divided by number of equity shares, you will get the EPS. Right, sir? In that last class, we have discussed till question number 6 of the ICAI book back. Now we are going to talk about question number 7. First, I will be solving that question number 7. Then, total 6 questions are pending. We'll try our level best to complete, sir, at least 4 questions today. Because 2 questions I want to solve face to face. Then you will be having more and more clarity, my dear lovable students. I'm starting the proceedings. Sir, very happy afternoon to all. We are going to solve question number 7. Company had the following balance sheet at the end of the current financial year. Fixed asset net 12.5 crores, whereas current asset is 7.5 crores. Total asset is 20 crores. Super, sir. Equity share capital total 5 crores. Reserves and surplus 1 crore. 15% debenture 10 crore. And current liability 4 crore. Total comes to 20 crores. The additional information given is as under. These are the additional information. Fixed cost per annum excluding interest is 4 crores. That means fixed operating cost is 4 crores. Variable operating cost ratio is 65%. If the variable operating cost ratio is 65%, 100 minus 65 is equal to 35% is the profit volume ratio. Total asset turnover ratio is 2.5 times. 2.5 is the total asset turnover ratio. Income tax rate is 30%. Calculate EPS, operating leverage, financial leverage and the combined leverage. My dear lovable students, in order to start with the income statement, you should have sales. As we all know that sales minus variable cost, you will get contribution. Minus fixed cost, you will be getting earnings before interest and tax. From that, we have to pay the interest. We will be getting the earnings before tax. From that, we have to pay the tax. You will be getting the profit after tax. Profit after tax, since there is no preference dividend, that will be exactly equal to the residual earnings. So, PAT is equal to residual earnings divided by number of equity shares. You will get the earnings per share as EPS, my dear lovable students. Actually, sales is missing. For that only, turnover ratio has been given. Total asset turnover ratio. This is form part of the ratio analysis. Total asset turnover ratio is equal to sales divided by total asset. Sales divided by, for example, any turnover ratio. For example, working capital turnover ratio. Sales divided by working capital. Sir, fixed asset turnover ratio. Fixed asset, sales divided by fixed asset. Current asset turnover ratio. Sales divided by current asset. That means any turnover ratio, my dear lovable students, is nothing but sales divided by that particular item. So they have given that total asset turnover ratio is equal to 2.5 times. 2.5 times is equal to sales divided by total asset of 20 crores. Are you really with me? That means sales is equal to 20 crores into 2.5 times comes to 50. 50 crores is the sale. Fantastic to the core. So I can fill now. I am writing in crores. 50 crores is the sale. In that, variable cost ratio has been given in the question, which is 65%. So variable cost ratio at the rate of 65%. 32.5 50 crore is a variable cost. So 50 minus 32 point come to 17.50 is the contribution. Fixed cost actually they themselves given in the question. What is the fixed cost per annum? 4 crores. So from 17.5 crores, if you reduce 4 crore, EBIT will be 13.50 crores. From that, we have to reduce the interest. If you see the balance sheet, you are having 15% debentures, sir, 10 crores. So 10 crore into 15% comes to 1.5 crore is the interest. Are you able to appreciate? So from 13.5 crores, if you remove 1.5 crores, you will get the 12 crores as the earnings before tax. Pay tax at the rate of 30%. That's what income tax rate. So 12 crore into 30% comes to 3.6 crores we have to pay as tax. So 12 crore minus 3.6 crore comes to 8.4 crore is the PAT, which is the residual earnings, which has to be shared by the equity shareholders. They themselves given that 50 lakh shares are there. So residual earnings divided by 50 lakh, which is, sir, 8.4 crores divided by 50 lakhs comes to 16.8 per share is the EPS. That is the first requirement of the question. Calculate EPS. Earnings per share is 16.8 per share. Are you getting it? Now the full income statement is available with me. I can easily find out the operating leverage, right, sir? Operating leverage is equal to contribution divided by EBIT. The contribution is 17.5 crores divided by EBIT is 13.5 crores. Getting it? So 17.5 crores divided by 13.5 crores comes to 1.30 times is the operating leverage. So what is the interpretation of this? If 1% change in sales will lead to 1.30 times change in EBIT. The next requirement of the question is the financial leverage. As we all know that financial leverage is equal to EBIT divided by EBT. Since every information has been given in the question, this formula I will use. So EBIT will be 13.5 crores, my dear lovable students, divided by EBT, earnings before taxes, 12 crores. Right, sir? That means 13.5 divided by 12 comes to 1.125 times. Sorry, 1.125. That means, my dear lovable students, if there is a 1% change in EBIT, will lead to 1.125% change in EPS. Right, sir? Then they want combined leverage. In two ways, we can calculate the combined leverage. Combined leverage either can be calculated by using the multiplication method or the formula method, which is operating leverage into financial leverage, which is nothing but 1.30 times into 1.125 times comes to 1.4625 times is the operating leverage, or operating leverage into financial leverage, which is contribution divided by EBIT into EBIT divided by EBT. EBIT and EBIT will get cancelled. So combined leverage is equal to contribution divided by EBT. Comfortable? Which is equal to contribution of 17.50 divided by EBT 12 crores. Are you ready with me? So 17.5 divided by 12 comes to 1.4583 times. But we are getting here 1.4625. The reason is here we have made a round off. It was actually 1.29 something, correct, sir? But we made it as 1.30. So in this scenario, if you want the real accurate answer, it's better to go with this root of 1.4583, which is contribution divided by EBIT. Otherwise, here you would have made a round off and here you would have made a round off. Then the answer will be something different with the change in fraction. So better to directly apply the operating leverage of contribution divided by EBT. Clarity? Now we will check what the ICAI is given. We got the EPS as 16.8 per share. Sir, what is our answer of EPS 16.8 per share? Can we proceed? Sir, they have given analysis also. It indicates the amount the company earns per share. Yes, every share is earning 16.8. Investor use this as a guide while valuing the share and making investment decision. It is also an indicator used in comparing firms within an industry or the industry segment. That means, for example, let me ask you a question. There are two cows are there. Cow. Have you heard about cow? Yes, sir. Mad. Sir, one cow is giving 5 liter pal and other cow is giving 8 liter pal. You tell me which cow you will give more money and buy 8 liters pal. Why? Because that cow is giving more liters of pal. Correct, sir? The same way, a share you are having more EPS will be having more value in the market. Because EPS show the earning capacity of a share. For example, one share is only EPS is 5 and other share is 8. Then in share market, automatically, already, this share will be having the higher value. Comfortable? So, it indicates the amount the company earns per share. Generally, EPS means how much one share is earning. Investor use this as a guide. Sir, if you have to invest in one company, for example, ANM classes, you will be checking the share value of the share value of the ANM classes will be decided by the EPS of the ANM classes. Are you all with me? So, investor use this as a guide while valuing the share, while valuing the and making investment decision. That means if a company is having more EPS, will have more value. It's same like a mad who are giving more pal will be having more value. Comfortable? It is also an indicator used in comparing firms within an industry or industry segment. For example, sir, in coaching industry itself, if company X is giving 8 per share and company Y is giving only 3 per share, you can have an intra-firm comparison with the EPS. Or you can have inter-segment comparison also. Everything is possible with the help of this tool called as earning per share. Generally, a share who are having more earnings will be having more value. Comfortable? I'm proceeding, man. Operating leverage. Operating leverage is equal to contribution divided by EBIT. What is the contribution? 17.50 crore. Divided by EBIT 1.296 times. But here we have rounded off as 1.30 times. Are you really with me? Sir, but they have written the same percentage. Hello, sir. So don't give round off. So instead of writing 1.30, we can write 1.296. They have taken 3 decimal point. They have given the analysis. It indicates the choice of the technology and the fixed cost in the what structure? Cost structure. That means inside my cost structure, already discussed, how much amount of fixed cost I am bearing, which will be shown by the operating leverage. It is level specific. That means if the fixed cost increases, automatically operating leverage increases. If the fixed cost decreases, automatically operating leverage decreases. So at what level, sir, you are incurring fixed cost? When the firm operates beyond operating what even level? Break-even level. Then the operating leverage will be low. For example, if your sales is more than break-even level, you will be having margin of safety. If you are having margin of safety, then automatically you will be having low business risk because you have covered the fixed cost. Right, sir? This we already discussed. It indicates sensitivity of earnings before interest and tax to change in sales at a what level? Particular level. That means if 1% change in sales will lead to how much percentage change in EBIT is what the operating leverage. So it's like the sensitivity. Sensitivity means the change. If 1% sales changes, how much percentage EBIT will change is what the degree of the operating leverage. Can I proceed, sir? Coming to the financial leverage, which is nothing but EBIT divided by EBT. or PBT, whatever it may be, which is 13.5 divided by 12 comes to 1.125 times. We also got 1.125 times. Are you really with me? What is the analysis of the financial leverage? Financial leverage is very comfortable since the debt service obligation is small vis-a-vis what? EBIT. Look at here, man. Sir, financial leverage. What is the EBIT of this concern? 13.50 crores. My company is earning 13.50 crores. But I am liable to pay an interest of only 1.5 crores. That means no need to fear, because tomorrow if the EBIT reduced by 1 or 2 crores also, I can still pay the interest, because whether I earned the EBIT or not, I am liable to pay interest, right sir? So this company in a very, very safer position, because this company is having only little amount of interest as compared to the EBIT what they are earning. For example, if the same company is earning only 1 crore, you just think, and if they are having an interest liability of 1.5 crore, will it be good for the company? No. That's what this analysis is saying. The financial leverage is very comfortable. Financial leverage is very comfortable since the debt service obligation is small as compared to the earnings before interest and tax. Now I am computing the combined leverage, which is nothing but degree of operating leverage into degree of financial leverage. They taken the full figure 1.296, which is nothing but degree of operating leverage, and 1.125, which is nothing but degree of, they got 1.458 times. Even we also calculated 1.458. We have written 3 also. They have stopped with 3 decimal. We have written 4 decimal. Are you already with me? What is the interpretation of the combined leverage? Combined leverage studies the choice of fixed costs in the what structure. Because from sales to EBIT, we are having cost structure. And choice of debt in the what structure? Capital structure. Below the EBIT, we are having capital structure. Correct, sir? So from sales to the EBIT, we are having cost structure. In that cost structure, how much amount of fixed cost we are having, whether we can have that much fixed cost, it measures the business risk, is what the duty of the operating leverage is all about. From EBIT to EPS, we are having capital structure. In that capital structure, whether, sir, the debt included decision is correct or not, will be checked by the financial leverage. So, cost structure analysis plus capital structure analysis is called as combined leverage analysis. Correct, sir? That's what they are saying. The combined leverage studies the cost of fixed cost in the what structure? Cost structure. And choice of debt in the capital structure. It shows how sensitive the change in the EPS. That is, how much percentage EPS will change if there is a change in sales. If 1% change in sales will lead to how much percentage change in EPS is what the combined leverage. The leverages such as operating, financial and combined are used as a measurement of risk. What risk, sir? Sir, operating leverage we will use to measure the business risk, and financial leverage we will use to measure the financial risk. Are you really with me? And combined leverage we will use to measure the total risk. What risk? So, every start of this question is from the assets turnover ratio. Assets turnover ratio is equal to sales divided by total asset. Comfortable? From there only we got the sales as 50 crore. We already done this part. Hello, sir. So, computation of PAT, profit after tax. Sales is how much crore? 50 crore. From that, reduce variable cost at the rate of 65%. You will get the contribution. Are you already with me? From that, pay the interest other than interest. Are you already with me? You will be getting earnings before interest and tax. Less interest on debenture. Already debenture information has been given in the balance sheet, which is 10 crore into 15% comes to 1 point. So you'll be getting profit before tax of 12 crore. Less tax at the rate of 30%, 3.6 crores. You'll be getting the PAT of 8.4 crores. This PAT of 8.4 crores has to be shared by the equity shareholders. Are you really with me? Then only you will get the EPS, man. That's what 8.4 crores. This is actually as per working note. Hello, sir. Divided by How much lakh share? 50 lakh shares. Every shares will be earning 16.8. Are you all really with me what I am talking to you? So look at the question, man. I'm reading the question once again. That's it, the explanation from my side. Company had the following balance sheet at the end of the current financial year. Fixed asset net 12.5 crores. Current asset 7.5 crores. Total 20 crores. This 20 crore I will use to apply the total asset turnover ratio. Paka? Equity share capital 5 crore, which is nothing but 50 lakh shares of 10 each. That 50 lakh I will use to find out the EPS because residual earnings divided by number of equity shares. Reserves and surplus they have given, no use. 15% debenture of 10 crore. So 10 crore into 15 percentage comes to 1.5 crores. This data I will use to find out the interest. Current liability, put it on dustbin. Addition information given, fixed cost per annum 4 crore, sales minus variable cost contribution minus fixed cost. This 4 crore is a fixed cost. They themselves saying that excluding interest. That means 4 crore is equal to fixed operating cost, not the fixed financial cost. Comfortable? Variable operating cost ratio has been given. So sales into 65% if I apply, I will get the total variable cost. From the sales, if I reduce the total variable cost, I will get the contribution. Comfortable? Total asset turnover ratio, according to me, this data is the hero in the question. If you clearly apply that sales divided by total asset, you will be able to find out the sales. From there, you can apply variable cost, you will get the contribution. If you reduce the fixed cost, you will get the EBIT. Comfortable? Income tax rate is 30% because from the profit before tax, you have to pay the interest. You will be getting the PAT, profit after tax. We have find out the EPS. Are you comfortable with the EPS? We have find out the operating leverage, contribution divided by EBIT. We have find out the financial leverage, which is nothing but EBIT divided by EBT. And we have find out the combined leverage, which is nothing but contribution divided by EBT or operating leverage into financial leverage. I hope that you are able to enjoy the question number 7 and you are able to understand a 360 leverage. Sir, perfect understanding with regard to question number 7. Yes, sir. If yes is the call, my dear lovable students, anyone is there in the online, just text me before I solve the next question, which is question number 8. Typically, I am not solving question number 8. I am moving into some other number. Hello, sir. Otherwise, take a 7 minutes time. You do that question by yourself. Then I will be solving another question, which may be question number 10 or 11 or 12. I will be solving. First, I will be solving question number 11, then 12. Then I will come back at the appropriate time. Take a break of 7 minutes time. Solve this question and come back. Yes, sir. I believe that you are comfortable with the last question. Yes, sir. We'll be solving question number 11 as the next question. Very easy question only. Very, very easy question. Yes. I'm moving into question number 11. You are given the following information of 5 firms of the same industry. Name of the firm MNPQR. Change in revenue. What do you mean by revenue? Sales. So this is a change in sales. Change in operating profit. As we already discussed that operating profit is equal to EBIT. So if you do change in operating profit divided by change in sales, you will be getting the what leverage? Operating leverage. Now change in EPS they have given. Change in EPS divided by change in EBIT will give you what? Financial leverage. Change in EPS divided by change in sales will give you what? Combined leverage. What they want? You are required to calculate for all the firms degree of operating leverage and degree of combined leverage. Degree of combined leverage. Just listen, very easy part only. Sir, I am going to calculate for the operating leverage for the 5 firms M, N, P, Q and R. P, Q and R. Please help me. What is the percentage change in EBIT? This is what my first information. Then percentage change in sales will be the second information. Then I will be getting the operating leverage. Right, sir? For the first firm, what is the percentage change in EBIT? 26%. What is the percentage change in sales? 28%. So 26% divided by 28% is equal to 0.92 times is the operating leverage. Are you all with me? Coming to the next firm, what is the percentage change in EBIT? 34%. What is the percentage change in sales? 27%. That means 34% divided by 27% is equal to 1.26 times. Comfortable, sir? Coming to the next one, firm P, what is the percentage change in EBIT? 38%. What is the percentage change in sales? 25%. So 38 divided by 25 comes to 1.52 times is the operating leverage. The next firm Q, what is the percentage change in EBIT? 43%. What is the percentage change in sales? 23%. So 43 divided by 23 comes to 1.87 times. Comfortable? I'm moving to the last form, my dear lovable students. What is the percentage change in EBIT? 40%. What is the percentage change in sales? 25%. So 40 divided by 25 comes to 1.6 times. Comfortable? This is what the what leverage? Operating leverage. They want one more leverage called as combined leverage. They want combined leverage. Shall we? For the combined leverage, first I need the firm name. What are the firm name? M, N, P, Q and R. Are you all really with me? First one. Sir, percentage change in EPS I want. And the next one, percentage change in sales I want. Then I want the combined leverage. Comfortable? What is the percentage change in EPS? 32%. What is the percentage change in sales? 28%. So 32 divided by 28 is equal to 1.14 times is the combined leverage. Getting it? My dear lovable students, to the next form, M, N, What is the percentage change in EPS? 26 percentage. Percentage change in sale? 27 percentage. So 26 percentage divided by 27 percentage comes to 0.96 times. Comfortable? What is the percentage change in EPS of the firm P? 23 percentage. What is the percentage change in sale? 25 percentage. So 23 percentage divided by 25 percentage comes to 0.92 times. 0.92 times. Comfortable? The next one Q. What is the percentage change in EPS? 27 percentage. What is the percentage change in sale? 23 percentage. So 27 percentage divided by 23 percentage comes to 1.17 times. Comfortable? Coming to the last firm, firm R. What is the percentage change in EPS? 28 percentage. What is the percentage change in sale? 25 percentage. 28 percentage divided by 25 percentage comes to 1.12 times is the combined leverage. Shall we check the answer? For the first firms, we have already calculated the operating leverage, my dear lovable students. The operating leverage is 0.929. We got 0.92 times. Are you ready with me? 1.26, 1.259. 1.52, we also got 1.52. 1.87, we also got 1.87. And 1.60, we also got 1.60. Are you comfortable? Look at that. We have done it as two table. They have done it as one table. You can do it as one table. Are you really with me? You can save the time in the examination. Now, man, coming to the combined leverage, which is nothing but the first one, 1.143. 1.143, we can add one more decimal. Always write 3 decimal in exam. So 1.143. Then 0.963. 0.963. Comfortable, sir? The next one, 0.920. Even we also got 0.920. 1.174. 1.174. And 1.120. Here also we got 1.120. Are you really with me? So my dear lovable students, that's it with regard to the question number 11. You know, this question is a past examination question. What is there in the question? You have to clearly take the relationship. Sir, operating leverage is equal to percentage change in EBIT divided by percentage change in sales. That's it. This formula we have already done. Degree of combined leverage is equal to percentage change in EPS divided by percentage change in sales. Are you comfortable? Sir, pause the video, take a break, solve this question, question number 11, and come back. We'll be solving the next question. Are you all really with me? Yes, I hope that you would have tried the last question and you are very comfortable with question number 11. We are moving into the last question, which is question number 12 of the book back of the leverage analysis. A very easy question. Following data has been extracted from the books of LM Limited. Sales 100 lakhs. Wow. Sales has been given in the question. Wherever question sales given, such question is Mangala. So 100 lakhs is the sales. Interest payable per annum. Interest is a financial item which should come below the EBIT. Operating leverage they gave 1.2 times. Combined leverage they gave 2.16 times. With this we can find out the financial leverage. Because financial leverage and interest is having a link. With that we can break the EBIT. Once we get the EBIT, we can crack with the operating leverage. We will get the contribution. We can fill the balance. What they want, you are required to calculate the financial leverage. We can easily calculate. Fixed cost, it will be a balancing figure. Profit volume ratio, contribution divided by sales into 100. Are you really with me? So my dear lovable students, question is saying that operating leverage is equal to 1.2 times. And combined leverage is equal to 2.16 times. So financial leverage is equal to combined leverage divided by operating leverage, which is 2.16 divided by 1.2 comes to 1.8 times is the financial leverage. As we all know that financial leverage is equal to EBIT divided by EBIT minus interest. Only this formula will work in this situation. Are you really with me? So 1.8 is equal to, I don't know the EBIT. So EBIT divided by EBIT minus interest is given in the question as 10 lakh. Are you really with me? I can easily cross multiply, which is 1.8 divided by 1. Are you really with me? Should be equal to this. So 1.8 EBIT minus 10 lakh into 1.8 comes to 18 lakhs. Should be equal to EBIT. That means 1.8 EBIT minus EBIT should be equal to 18 lakh. That means 0.8 EBIT is equal to 18 lakhs. So EBIT is equal to 18 lakhs divided by 0.8 comes to 22 lakh 50,000 is the earnings before interest and tax. I can copy here. Sales minus variable cost is contribution minus fixed cost is earnings before interest and tax. From that EBIT, reduce the interest, you will be getting EBT. Just now I find out the EBIT as 22 lakh 50,000. They themselves given in the interest as 10 lakh. So 12 lakh 50,000 is the EBT. Now I am having EBIT and operating leverage in my hand. I can knock off the contribution, right sir? Operating leverage is equal to contribution divided by EBIT. What is operating leverage? 1.2 is equal to contribution divided by 22 lakh 50,000. So basically contribution is equal to 22 lakh 50,000 into 1.2 comes to 27 lakh is the contribution. Comfortable? I can fill the contribution here, man. 27 lakh. Then automatically the balance will be the fixed cost. Fixed cost will be 4 lakh 50,000 is the fixed cost. Comfortable? Sir, now I know the contribution and I know the sales. So the balance will be the variable cost. Correct? 100 lakhs minus 27 lakhs comes to 73 lakh should be the variable cost. What are the requirement of the question? I am going to write the answer. Number 1. Financial leverage is the first requirement. 1.8 times is the financial leverage. Number 2. Fixed cost is the second requirement. Fixed cost is equal to we already got as the balancing figure 4,50,000 as the fixed cost. Are you all getting it? And the third requirement is PV ratio. We have to calculate the PV ratio, which is contribution divided by sales into 100. What is the contribution? 27 lakh divided by 100 lakhs into 100 means 27 percentage is the profit volume ratio. Profit volume ratio. Comfortable? Second answer, man. Calculation of financial leverage 1.8. Have we got? By, sir, now I am going to calculate the fixed cost. Degree of financial leverage by using 1.8. We got EBIT as 22,50,000. Have we got? So, the contribution as 27 lakh by applying to the operating leverage. Have we got? So, the fixed cost will be the balancing figure 4,50,000. We got the right answer, right, sir? PV ratio is equal to contribution divided by sales into 100, which come to 27 percentage. Are you all really with me? That's it, man. That's it with regard to the 12th question of the leverage analysis. With this, all the 12 questions of the leverage analysis comes to an end. Have we missed any question? Yes, sir. Question number 8, 9, 10. 3 questions are pending. Right, sir? 3 questions are pending. In that, my dear lovable students, can we solve question number 10 also today? Yes, sir. Then we can keep question number 9. Tomorrow we can solve in the class itself. And even question number 8, tomorrow we can solve in the class itself. It's not very tough, I will not say, but everyone is there in front of me. It will be better to convey the full details of the question. The remaining question, if you don't see the live also, you itself can try and you itself can get the answer by yourself itself. Correct. Here there is a chance of going wrong. So we'll be completing question number 10 and we can wind up for the day. And 2 questions, when we discuss the ratio analysis, we'll be completing that part. Comfortable? So take a 7 minutes time, quickly solve and come back. We'll be finished off with question number 10. Yes, sir. We are moving into the last question for the day, which is question number 10. Correct, sir? Other than this, we'll be having only 2 questions pending that will be solved in face-to-face class. Shall I start the proceedings? Yes, sir. Yes, sir. I'm moving into question number 10. Following details of a company for the year ended 31st March are given below. Operating leverage is 2:1. So in the question, they have given operating leverage is equal to 2 times. 2:1 means 2. Combined leverage is 2.5:1. So combined leverage is equal to 2.5 times. Basically, with this, we can find out the financial leverage, right, sir? So financial leverage is equal to combined leverage divided by operating leverage is equal to 2.5 divided by 2 comes to 1.25 times is the combined financial leverage. Fixed cost excluding interest, they have given 3.4 lakhs. Okay, fine. So basically in the income statement, sir, sales minus variable cost, contribution, minus fixed cost, earnings before interest and tax. Minus interest, you will be getting earnings before tax. If you reduce the tax, you will be getting the PAT, profit after tax. In that fixed cost has been given 3,40,000 is the fixed cost. 3,40,000 is the fixed cost. Comfortable? Yes, sir. Sir, sales is 50 lakhs. They have given sales as 50 lakhs. Okay, fine. Very good. Sir, 30.25 lakhs is the debenture. 30,25,000 into 8% will be the interest. 2,42,000. So 30,25,000 into 8% come to 2,40,000. But I don't know whether only this 42. I don't know whether only this much interest is there, because we have done such a similar question where if the financial leverage should match. Correct, sir? Equity share capital 34 lakh. So 34 lakh divided by 10 comes to 3,40,000. Comfortable? Income tax rate is 30%, my dear lovable students. Calculate the financial leverage. We have calculated the financial leverage. Financial leverage is equal to, sir, combined leverage divided by operating leverage is equal to 1.25 times. We have done 1.25 times. They want PV ratio, profit volume ratio, contribution divided by sales into 100. And EPS, earnings, sir, per share. If I have to get the EPS, I have to come down. In the sense means, sir, I am having fixed cost with me. I am having interest with me. Right, sir? Sir, both route I can travel. Both the routes I can travel. I will tell you how to open the route and what controversy you will be getting if you open the route. First, is interest given in the question? With the use of interest, I can proceed to the financial leverage. Financial leverage is equal to EBIT divided by EBIT minus interest. Correct, sir. What is the financial leverage? 1.25 is equal to EBIT divided by EBIT minus interest of 2,42,000. Comfortable? So 1.25 divided by 1. Correct, sir? So my dear lovable students, 1.25 EBIT minus 2,42,000 into 1.25 comes to 3,02,500 is equal to EBIT. So my dear lovable students, 1.25 EBIT minus EBIT is equal to 3,02,500. That means 0.25 EBIT is equal to 3,02,500. And EBIT is equal to 3,02,500 divided by 0.25 comes to 12,10,000. Like that, I can proceed. So I can say that my EBIT is 12,10,000. If my EBIT is 12 lakh 10,000, from that, if I am reducing 2 lakh 42,000, I will get 9 lakh 68,000. Comfortable? Less tax at the rate of 30% given in the question. So 9 lakh 68,000 into 30% come to 2 lakh 90,400. That means 6 lakh 77,600 is a PAT. Sir, I want EPS. Earnings per share is equal to residual earnings divided by number of equity shares. Comfortable? So PAT is equal to residual earnings. Is there any preference share capital? No, sir. So 6 lakh 77,600 divided by 3 lakh 40,000 comes to 1.992 per share is the EPS. 1.993. 3 per share is the EPS. Comfortable? But I have a doubt. After doing this part, is my financial leverage matching or not is the question. Because I should get 1.25. Sir, my financial leverage is equal to EBIT divided by EBT. What is EBIT? 12 lakh 10,000 divided by 9 lakh 68,000. Comfortable, sir? Sir, 12 lakh 10,000 divided by 9 lakh 68 comes to 1.25 times. It will match, it should match. Because we proceeded with 1.25 only. We proceeded with 1.25 only. That means we were having an assumption that more than 2,42,000 interest is not there. More than 2,42,000 interest is not there. We finalized that this is the maximum interest. Hello, sir. My dear lovable students, don't get irritated. I am writing the income statement once again. Sales minus variable cost contribution minus fixed cost is EBIT. Minus interest is EBT. Minus tax at the rate of 30%. You will be getting the PAT. Profit after tax. Comfortable? What and all information given in the question? Sales. How much? 50 lakhs is the sales. Okay, fine. Fantastic. Then fixed cost 3 lakh 40,000. 3 lakh 40,000 is the fixed cost. Comfortable? What is the next data? Interest. How much? 2 lakh 42,000, which we have calculated. Right, sir? Sir, in option number 1, I trusted the interest. But now I am trusting the fixed cost. I am trusting the. My dear lovable students, operating leverage is equal to contribution divided by contribution minus fixed cost. Clarity? What is the operating leverage? 2 times. 2 times is equal to, what is the contribution? Don't know. Contribution divided by contribution minus fixed cost of 3,40,000. Can I cross multiply? That means 2 contribution minus 6,80,000 should be equal to contribution. That means 2 contribution minus contribution is equal to 6,80,000. That means contribution should be equal to 6,80,000. Comfortable? So my dear lovable students, if 6,80,000 rupees is the contribution, from that if you reduce 3,40,000 as fixed cost, your EBIT will be 3,40,000 as the EBIT. Comfortable, sir? Now you are having EBIT in your hand. Correct, sir? If the interest is 2,42,000, 3,40,000 minus 2,42,000 comes to 98,000 will be the EBT. 98,000 will be the. Here you check the operating leverage. Contribution divided by EBIT. 6,80,000 divided by 3,40,000 comes to 2 times is the operating leverage, which is matching with the question. Now coming to the financial leverage, EBIT divided by EBT. which is 3,40,000 divided by 2,42,000 comes to, 98,000. 98,000 comes to 3.469 times. What is the financial leverage you got as answer? 1.25. Is it matching? No, it will not match. It should not match because you will get alternative questions, alternative answer. Sir, why I am getting alternative answer? Because if you have to either assume that fixed cost is only this much, or you have to assume that interest is only this much. If you are assuming fixed cost is only this much, then interest will change. You will be having more than 2,42,000 rupees interest. Comfortable? If interest is more than 2,42,000, then only, my dear lovable students, or it should be less than 2,42,000 also. Because there is no need that debt should be there for the entire 12 months. Debt may be there for less than 12 months, or you may have more debt also. So you are having two components in this question. One is fixed cost and other is the interest. It's always better to assume fixed cost as fixed. Whatever fixed cost given in the question, we can take it as fixed, because other than that amount, there won't be any more amount of the what cost? Fixed cost. But debt, we can't say like that. We may have more debt and we would have repaid that debt before the end of the financial year. Or this debt itself will not be there from the start of the financial year. Are you understanding what I am talking to you? So there is no need that 2,42,000 should be the interest. So if you are believing interest, your financial leverage will match. Your financial leverage will match by taking the interest as fixed. Don't do that. Take the fixed cost as fixed. Are you all really with me? So my dear lovable students, in this, alternate number 2, we have assumed that fixed cost as fixed. Comfortable? So we got the operating leverage. By applying the operating leverage, we got the contribution. What is the contribution? 6,80,000. Sir, I have believed that 3,40,000 is the what cost? Fixed cost. Now, I don't know what is the EBT. Now I am having EBIT in my hand. By applying the financial leverage, I can find out the interest component. Are you really with me? So I know that my financial leverage is equal to EBIT divided by EBIT minus interest. Here I am keeping interest as the balancing figure. What is the financial leverage? 1.25 is equal to, what is EBIT? Just now, have you got EBIT? 3,40,000 as the EBIT. So 3,40,000 divided by 3,40,000 minus interest. Comfortable, sir? Shall we cross multiply? So 3,40,000 into 1.25 comes to 4,25,000 minus 1.25 interest is equal to 3,40,000. Getting it? That means 4,25,000 minus 3,40,000 comes to 1.25 interest. 4,25,000 minus 3,40,000 comes to 85,000 is 1.25 interest. So interest is equal to 85,000 divided by 1.25 comes to 68,000. Only that much interest is there. That means, my dear lovable students, 68,000 is the interest. But what is the debt given in the question? 30,25,000 into how much percentage? 8%. Sir, the total interest comes to 30,25,000 into 8% come to 2,42,000. This will be the interest if the debt is outstanding for entire 12 months. Who said that from April 1st itself this debt is outstanding? Such an information is not given in the question. This may be for 3/12 or 6 by 12 or 9 by 12, which is missing in the question. So it is illogical to assume that this much should be the mandatory interest. Comfortable? Are you agree with me? If nothing has been given, I will assume like that. But they themselves calculated their own financial leverage, right, sir? So 3,40,000 minus 68,000 come to 2,72,000 should be the earnings before tax. That means, my dear lovable students, 3,40,000 divided by 2,72,000 comes to 1.25 is the financial leverage. Now it is exactly matching. Yes, sir. Now only it is matching. That means if you are traveling through the interest as the fixed component, you will get financial leverage correct. But operating leverage wrong. Clear? Better to travel through the operating leverage, that is fixed cost as fixed, because I can't say that there will be more fixed cost than this. Never possible. I can't say that fixed cost is only for the first 3 months. Never possible. Fixed cost will be there for the entire 12 months. Generally. Are you really with me? Whereas interest is not like that. There is no guarantee that you have really paid only this much interest, or you have paid less than 2,42,000. Anything will be possible. Comfortable. So I will believe the fixed cost and I will be calculating the operating leverage first. Then I will apply the financial leverage. Then I will find out the interest as the balancing figure. So on 2,72,000, if I find out 30%, 81,600 I will pay as tax. From the 2,72,000, if 81,600 goes means 1,90,400 is the profit after tax. Comfortable? So my dear lovable students, what they want in the first question? Sir, PV financial leverage. Have you find out financial leverage? Yes, sir. They want PV ratio and EPS. Is there any preference dividend? No. So from the PAT, I can calculate the, sir, EPS. So EPS is equal to PAT divided by number of equity shares. Comfortable, sir? The PAT is 1,90,400 divided by 3,40,000 equity shares comes to 0.56 per share is the EPS. Comfortable? What's the next one? PV ratio. Here itself I can calculate the PV ratio. Sir, my PV ratio is equal to contribution divided by sales into 100. That means 6,80,000 divided by 50 lakhs into 100 means 13.6% is the profit volume ratio. Getting it? Now they are having some different story. If the company belongs to an industry whose asset turnover is 1.5 times, that means for this company, mandatory 1.5 times should be the assets turnover. Does it have high or low asset turnover is the question. So I have to calculate the total asset turnover ratio. Total asset turnover ratio is equal to sales divided by total asset. Comfortable? Sales is equal to, given in the, we have find out 50 lakhs. Already given in the question, 50 lakh. Sir, total asset is equal to, if you add debt and equity, you will get the liability side total. Liability side total will be equal to the asset side total. Comfortable? So 30,25,000 plus 34 lakh will be the total asset. Comes to 64,25,000 is the total asset. That means 50 lakh divided by 64,25,000 comes to 0.78 times. Generally, any company in this industry is having 1.5 times. But our company is having only 0.78 times. That means our asset turnover ratio is less than the industry standard. Are you really with me? We are not performing well because everyone is performing 1.5 times. But we are performing only 0.78 times. Moving to the last part of the question. At what level of sales? So we have to find out a particular level of sale. The earnings before tax of the company will be equal to what? 0. This can be find out by this way, simple, our statement approach, or you can follow the leverage approach also. Sales minus variable cost contribution minus fixed cost means earnings before interest and tax. Less interest, you will be getting earnings before tax. You have to pay tax at the rate of 30%, you will be getting PAT, correct? But they want EBT of what? 0. If EBT is 0, automatically tax will be 0. If the tax is 0, PAT will also be 0. Comfortable? Interest is fixed. Just now we have argued for the interest. We said that interest is only 68,000. Comfortable? As per our fixed cost fixed approach. Comfortable? So 68,000 is the interest, means EBIT should also become 68,000. Then only EBT will become 0. Sir, we have trusted the fixed cost. We have assumed that fixed cost given in the question is fixed, right sir? So the fixed cost, sir, is 3,40,000. Comfortable? So automatically contribution will be 3,40,000 plus 68,000 comes to 4,08,000 should be the contribution. Just now we find out the profit volume ratio, correct? We know that PVR is 13.6%. That means, sir, 4,08,000 divided by 13.6% comes to, so at a sales of how much lakh? 30 lakh. I will be having EBT of 0. Are you all really with me? My dear lovable students, if my EBT is 0, automatically my PAT will be equal to 0. Profit after tax will be equal to 0. If PAT is 0, automatically my EPS will become 0. Correct? So, percentage change in EPS should be 100%. Because whatever may be the EPS, you can assume it as 1 rupee, 2 rupee, 5 rupee, 10 rupee, 25 rupee. It is going to become 0, means 100% it should fall. Are you really with me? So my dear lovable students, percentage change in EPS will be how much percent? 100%. What they are saying? At what level of sales? So I have to find out the sale. Level of sale. Where the earnings before tax, EBT of the company should be equal to what? 0. Look at here. ICAI is having a very good approach for that. I will first confirm the answers for whatever we have done. Degree of financial leverage. Financial leverage is equal to combined leverage divided by operating leverage, 1.25 times. Since the combined leverage given in the question, operating leverage given in the question, mandatorily this should be the financial leverage. There is no doubt about it. Because this is the fact. This is not the assumption given in the question. Comfortable? My dear lovable students, profit volume ratio and the EPS. Sir, degree of operating leverage is equal to contribution divided by contribution minus fixed cost. So, they have not traveled through the interest route. They have traveled through the fixed cost route. They assume that fixed cost to be fixed. That is more logical. And they find out that contribution as 6,80,000. Sir, here we got contribution as 6,80,000. But if you are traveling through the interest route, you won't get this contribution. You'll be having something different. Are you all really with me? My dear lovable students, they have calculated PV ratio. 13.6% is the PV ratio. We also got 13.6% as the PV ratio. Can I proceed? My dear lovable students, earnings before tax, they got 98,000. We also got earnings before tax as 98,000 or EBT as something different, 2,72,000. Hello sir. We got contribution as 6,80,000. Is it right? Yes sir. But they are getting earnings before tax as 98,000. Hello sir. From that they paid tax and PAT as 68,600. But we got something different. Correct? Why? We are going to analyze. Look at here. Sir, what is the sales? 50 lakhs. Minus, sir, you will be having variable cost. You know the profit volume ratio? 13.6% is the profit volume ratio. So, 50 lakhs into 13.6% will be your contribution. Correct, sir? So, 50 lakhs into 13.6 come to how much? 6 lakh 80,000. We also got 6 lakh 80,000, which is nothing but 13.6% of sales. Are you really with me? Minus fixed cost is how much? What is given in the question? There is no doubt about it. 3 lakh 40,000. Comfortable? So from 6 lakh 80,000, if you reduce 3 lakh 40,000, balance 3 lakh 40,000 is the EBIT. Are you really with me? But ICAI has considered the entire debt into how much percentage? 8%. Entire debt into 8%. If you consider like this, sir, 30 lakh 25,000 into 8%, your interest will be 2 lakh 42,000. So they have taken 2 lakh 42,000. Are you appreciating what I am talking? So look at here. From 3 lakh 40,000, if you reduce 2 lakh 42,000, you will get the EBT as 98,000. Are you getting it? This is what they got it as 98,000. But if 98,000 is the EBT, financial leverage will not match. Financial leverage will not. They are writing as note and it will not match. Look at here, note. The question can also be solved by first calculating what? EBIT. With the help of what leverage? Accordingly, answer to the requirement of 2 and 4 will also vary. That means they are saying that instead of traveling through the fixed cost approach, you can travel through the interest approach also. If you are traveling through the interest approach, you will assume 2,42,000 as the interest. Then financial leverage will match, operating leverage will not match. As per our answer, both are matching. Are you really with me? So basically, it is an assumption. What we are assuming that the debt is not there for the entire year. If you are very strictly saying that, no, sir, I want the total interest to be 2,42,000 instead of 68,000, then operating leverage, sir, will not match. What will match? Sir, one thing will not match. If you want both the financial leverage and operating leverage, this should be the answer. Sir, this is a contradictory answer to the ICAI. Are you able to think it? Are you able to think it? So, if it is not matching in examination, we have to write a note. We have to write a note. If you are writing this answer, you have to write a note that it is assumed that the debt is not there for the entire 12 months and interest is not 2,42,000. Interest is only 68,000. Getting it? Are you all really understanding? So, if you are taking the full interest, obviously, sir, earnings before tax will be only 98,000. From that pay 30% tax, you will be having the PAT. So, PAT divided by number of equity share, automatically who will change? EPS will change. We have taken only, sir, 68,000 as interest. If we are taking only 68,000 as interest, only our EBT will be more and we are liable to pay more tax. Automatically will be having more PAT. Are you really with me? Because we have reduced the interest. But ICAI is saying that no. Hello, sir. But after doing the ICAI answer, sir, operating leverage will match. But financial leverage will not match. Financial leverage will not match. Are you really with me? If you want, you can check it. Sir, what is the EBIT of ICAI? 3,40,000. There is no change about it, right, sir? Here you are having EBIT, 3,40,000. Correct? EBIT, earnings before interest and taxes, 3,40,000. What is the EBT of ICAI? 98,000 is the EBT. So 3,40,000 divided by 98,000 comes to 3.469. But the real financial leverage is 1.25 times. It will not match. Hello. Sir, I want to match both. That's what I have done. That means you have to reduce the interest. Then only it will match. So like this contradiction will or can happen in exam. At that time, you have to write assumption or you have to write your note below the answer. Comfortable? So surely EPS will change. Our EPS and their EPS. Are you really with me? Now with regard to asset turnover, are you clear with the question? With regard to asset turnover, this company's asset turnover is 0.6. 7, 8 times, which is much less than 1.5 times, right, sir? So that means it is lower than the industry turnover. Comfortable, sir? Sir, how to find out total asset, which is nothing but equity share capital plus the debt, will give the total capital employed, which is nothing but the liability side of the balance sheet. Liability side of the balance sheet will be equal to the asset side of the balance sheet. This I loved really very much. They are saying that EBT should become 0. EBT becomes 0. In order to EBT become 0, EBT should drop by 100%. Right, sir? We all know that combined leverage is 2.5 times. Correct, sir? Sir, sales have to be dropped by, for example, look at the way in which their analysis. Sir, now the EBT should become what? 0. What is combined leverage? If 1% change in sales will lead to how much percent change in EPS? I know that EBT is going to become 0. If EBT is going to become 0, automatically EPS is going to become 0. That means the percentage change in EPS is going to be 100%. So this is sales and this is EPS. They have given 100% is the fall in EPS. Their question is how much should fall the sales. Comfortable? We all know that combined leverage is equal to percentage change in EPS divided by percentage change in sales. Comfortable, sir? What is the current combined leverage? 2.5. So 2.5 is equal to, I know percentage change in EPS as 100% divided by percentage change in sales. Are you all with me? So percentage change in sales is equal to 100 divided by 2.5 comes to 40%. That means, sir, if the sales falls by how much percent? 40%, EBT will become 0. Automatically EPS will become 0. Getting the analysis? That means the new sales will be current sales into 60% because 40% is going to lesser. What is the new old sale? 50 lakh. 50 lakh into how much percent? 60% comes to one shot they reach 30 lakh. Another way of doing the question. Really, I like the way in which ICAI has solved that. Are you all really with me? Therefore, at 30 lakh level of sale, EBT of the company will be 0. Or if you want the required sale when EBT is 0, sir, look at that. Fixed cost plus interest plus desired profit divided by PV ratio. ICAI is having alternate answer. What is the fixed cost? 3,40,000. There is no change in it. What is the interest? 2,42,000. There is no change in it. What is the profit you want? 0. Are you really with me? Divided by PV ratio of 13.60%. Hello, sir. Sir, here I got, sir, interest as 6,80,000. That's 68,000. That's why I got how much lakh? 30 lakh. If I am changing interest, my EBT will change. If my EBT changes, since the fixed cost is fixed, my contribution will change. Sir, on that desired contribution divided by PV ratio, surely my sales will change. Correct? Are you able to picturize? So, my dear lovable students, it should be, tell me, if I am taking interest of how much rupees? How much rupees? 2,42,000 instead as 68,000. Here I should get 2,42,000. Correct, sir? Plus the fixed cost will be how much? 3,40,000. Comfortable. So, my dear lovable students, 3,40,000 plus 2,42,000 comes to 5,82,000. This should be equal to 13.6%. So, 5,82,000 divided by 13.6% comes to 42,79,412 will be the sales. If you are making this much sales, my dear lovable students, your EBT will be 0 at that level of interest. I hope that I have given all the level of clarity for this question. If you go this way, what will be the answer? If you go this way, what will be the answer? This is how you have to study the costing and FM. It should not be like a by heart where you will be solving something you are getting matching with ICAI. What they have done. If I don't travel through this route, what will happen? what is the difference between traveling through the fixed cost route and also the interest route? If I am taking the full interest, my financial leverage will not match. Sir, it is not matching is not a problem. Let it not match. Why it is not matching? That understanding is what the knowledge. Are you really with me? That's it with regard to the question number 10. According to me, a beautiful and a fantastic question. Take a break of 7 minutes. Solve this question. Question number 10. Nothing more from today solving. My dear lovable students, only 2 questions we are pending, which is question number 9 and question number, is it 8? 8. Sir, like this, some intricacies are there in that question. So if I solve in face to face, I can quickly convince, sir, what those questions are all about. So take these 3 questions as assignment, complete this or 4 questions as assignment. We'll be doing the remaining 2 questions in the face-to-face class. If anyone is watching this video, if you understand the way in which we have solved, just text me in the comments. We'll meet at the appropriate time.